Mergers have been active in the business world from the 1890s. During this, JP Morgan helped US Steel merge with Carnegie Steel and over 700 smaller steel firms. How did it help? The merged company had a market share of over 70 to 80% of the USA. Like JP Morgan helped the steel company merger, banks play a crucial role in helping companies merge together. But what about the mergers in the banking industry? So let's explore mergers in the banking sector and what are their pros and cons. Over the course of time, the banking sector has witnessed a great deal of mergers. Even our own State Bank of India was formed by merging the Bank of Calcutta, Bank of Madras and Bank of Bombay to first form the Imperial Bank of India, which after independence came to be known as the State Bank of India. So how do mergers work? The firms that agree to merge are usually roughly of the same size, customers and their scale of operations. When mergers are considered, a public company or a bank has to confront their shareholders with the merger idea. The firms can merge only when the majority of the voting shares are in its favor. In the recent times, there was a conglomerate bank merger that took place in India. HDFC and HDFC Bank combined their forces together. Now, this was a smart and strategic move. Banks are now able to offer loans at low rates and NBFCs have great rural penetration. So now they can offer more loans to the rural population at lower rates. Back when SBI was formed, banks merged in order to survive. According to a research paper, Mergers and Acquisition in PSU Banks by IIBF, merging helps the two banks expand their reach and leverage each other's resources. It further helps them in reducing the probability of bankruptcy. So, banks used to merge in order to save their businesses. Today, however, times have drastically changed. In the late 2000s, SBI merged with two more banks and five more less than a decade later. It wasn't done to save SBI, right? Similarly, the HDFC Twins merger or even the Bank of Baroda merger wasn't done to save any dying companies. No, they merged to expand. They merged to grow. They understood the strengths their counterparts held and decided it was a mutual benefit to grow together. Last year, our finance minister announced that 10 public sector banks were to be merged into 4. The Oriental Bank of Commerce and United Bank of India merged with Punjab National Bank, Allahabad Bank with Indian Bank, Syndicate Bank with Canara Bank and Andhra Bank with Corporation Bank merged into Union Bank of India. The goal was to create a stronger, more global set of 3 or 4 banks instead of multiple small regional banks. Nirmala Sitharaman said, even before the pandemic, one of the driving forces for the amalgamation was the need to scale up banking. India needs a lot of banks, but a lot of more big banks. So, what are the benefits of merging? Every time banks merge, the merger also benefits the customers, since they can avail a wider range of products to choose from in insurance, mutual funds and loans. The banks benefit by getting access to more capital, a wider reach, better technology and resources. Their lending capacity increases and thus they will have stronger balance sheets. The government benefits from reduced needs for recapitalization for these PSUs in case of the public sector merging. So mergers have practically been a win-win for most cases. But of course, it isn't all sunshine and rainbows. There are certain challenges that the bank needs to face. For starters, the acquiring bank or the anchor bank needs to bear the burden of bank with weaker balance sheets. When companies merge, it is difficult for the leaders to maintain a common work culture, since they all come from different environments. Plus, it takes time for the systems and processes to align. Thus, customers face a lot of challenges during the transition phase. But that being said, mergers have proved to be incredibly helpful for banks looking to expand and grow the economy. It will be exciting to witness the change in our banking industry as the new mergers begin to build stronger and larger banks.